Okay, our numbers seem to be holding pretty steady here. I know others will be joining as the day goes on, as the morning goes on. We have an hour here. Welcome, I'm Tom Reynolds with the Maryland Municipal League. I know many of you who are joining here today. And today's session is on fiscal recovery funds and revenue loss and how to calculate revenue loss, which is a really important part of being able to determine what you can use, how you can use your money, and opening up some greater potential for use of the American Rescue Plan funds. So I want to say thank you to the Department of Budget and Management and Haggerty Consulting. And just a couple quick housekeeping points. The first is we're obviously going to be taking Q&A as this goes along. We ask that you put your questions in the Q&A box rather than the chat. We'll try and share some additional information in the chat as the session goes on, and your questions will be answered. I know that the folks from Haggerty will try and get to as many questions as they can as things roll through, but most of the questions will be saved to the Q&A at the end. So with that, I want to turn things over to Jeff Wolbrick with the Department of Budget and Management. Good morning, Jeff.
Thanks, Tom. My name is Jeff Wolbrick with the Department of Budget and Management, standing in for Mark Nicole this morning on our intro remarks. Of course, I have my team from Haggerty here. Today, John Hageman will be delivering most of the presentation. I also have Emiliano Segura here, who is our technical assistance lead. Ben Shea, Kristen Kerr, and Dana Lustig are also members of the team that I'm sure you're familiar with at this point in time. As you know, this webinar is part of the state's technical assistance program. We are thrilled to co-sponsor this with the Maryland Municipal League. Our partnership has been vital in ensuring NEUs get their information out in a timely manner through us and Haggerty. We're excited to confirm that the state has dispersed 100% of the first tranche award amounts to all non-entitlement units. You can find the details of that on in our government report, which is posted on the state's NEU website. We do appreciate everyone who completed the Technical Assistance Program survey. We received over 50 responses, and we're definitely incorporating your feedback into our program. We're also actively working to enhance the flexibility and accessibility of this program, as you all have expressed your resource constraints, and we totally understand that situation. Please continue to submit any questions you may have on ARPA and fiscal recovery funds through our portal. To date, we've received over 140 questions. The most popular questions, as you may be aware, are around economic impacts, water, sewer infrastructure, and maintaining and restoring public services. So we really appreciate your collaboration, and we think this is a great tool for you all to get your questions answered, and please continue to send them in to us. More importantly, keep an eye out for our upcoming newsletter. We'll continue to provide regular programmatic updates on resources, events, and other initiatives we're working on to better serve you. With that, I will turn it over to John Hageman to start our official presentation here. Thank you.
Great. Good morning, everyone, and thank you, Jeff. As Jeff mentioned, my name is John Hageman. I'm a senior manager at Haggerty Consulting. I oversee the firm's American Rescue Plan service offering and lead our engagement with the state of Maryland, including the NEU Technical Assistance Program. Next slide, Dana. Just a brief agenda for today. We're going to talk, really start off around the eligible use categories. Then we'll dive into some background on revenue loss and major important items to keep in mind. Then we're going to really get into the definition of general revenue, what's in, what's out. We'll go through the calculation based upon U.S. Treasury's guidance, as well as an example, that being the state of Maryland's revenue loss calculation. We'll then talk about eligible and ineligible uses under the revenue loss provision, including the flexibility associated with revenue loss. And as Tom said at the beginning, we'll take any questions and answers either throughout the presentation, and if we don't hit on those during the presentation, we'll be sure to mention them at the end. I want to reiterate, please go ahead and direct your questions in the Q&A box as opposed to the chat function. And with that, Dana, you can go to the next slide and we'll go ahead and get started. As you all know, there are 4 eligible use categories when it comes to the fiscal recovery funds: supporting public health expenditures and addressing negative economic impacts, replacing lost public sector revenue, which is the topic of today's webinar, providing premium pay for essential workers, and investing in water, sewer, and broadband infrastructure. I think it's important that we really frame revenue loss within the context of the eligible uses, because to the extent there are other eligible uses to use to pay for projects or programs that you're thinking of, it's important to focus on categories 1, 3, and 4. And to the extent you do have revenue loss, really reserve that category for other uses that may not fall into eligible categories. And we'll talk a little bit about that later in the presentation. Next slide, please. So some background on revenue loss. As I mentioned, this is under eligible category number 2, being able to provide the provision of government services to the extent of the reduction of revenue due to the COVID-19 public health emergency. Revenue loss is one of the most flexible uses of funds. Local governments, and this is Treasury's phrase, has broad latitude to use the fiscal recovery funds in relation to revenue loss. And we'll talk a bit more about that flexibility. I did want to call out that the interim final rule includes the information that we're going to be reviewing today. The interim final rule really is organized around the definition of general revenue, which we'll talk a bit about, the methodology associated with calculating the revenue, and then they provide guidance on what the replaced revenue can and cannot be used for. I do also want to mention, as you all are beginning to think about reporting, and you can find the state's reporting guidance on its website related to the NEU Technical Assistance Program, that NEUs, to the extent they do decide to use revenue loss, are required to report on revenue loss during the annual project and expenditure report. I also want to note, and this is related to the flexibility of these use of funds, that there are reporting implications depending upon what category of use you use. So to the extent you do decide to utilize the revenue loss category, the reporting requirements do vary versus other categories. So it's important to keep in mind, the various reporting implications that may occur when using this category versus another category. Next slide, Dana. So I want to talk a bit about the definition of general revenue and where it comes from. The definition is really based on, but not completely identical to, the components reported in the general revenue from owned sources in the Census Bureau document. And we've included a link to that document in the appendix, and it's also referenced in the interim final rule, as well as Treasury's frequently asked questions. The concept behind the general revenue definition is really to capture those revenues collected by a recipient and generated from its underlying economy, as opposed to funds or administrative functions that account for accounting transactions. So Treasury's intent with the definition, as I mentioned, is to really focus on that economic activity and the revenue sources that make up your community's local economy. Another piece to keep in mind is that general revenue is looked at by Treasury in sum. So many local units of government, may have revenue loss in one category, or they may be looking to replace revenue loss just associated with that one category. It's important to keep in mind that the calculation needs to occur in looking at the sum of all the revenue streams covered as part of the general revenue, as opposed to looking at individual revenue sources. And we'll talk a bit more about that and the implications for that when we talk about various examples of what's in general revenue. Next slide, Dana. We wanted to include what we see as a key resource for you all in thinking through the definition of general revenue. This document is included in Treasury's FAQ in their appendix section. We think it does a really nice job of laying out at a high level what revenues are included and not included. And as I mentioned, we've included a link to this document and the FAQ more broadly in the appendix of this presentation. Next slide, Dana. Now, I want to talk a bit about general revenue streams and give some examples of the elements that are included in the revenue calculation. As a part of the NEU Technical Assistance and Distribution Program, many of you all submitted budget information. We went through those documents and looked at some publicly available budget documents to really understand the major revenue streams that you all may be leveraging and may be associated with your revenue loss calculation. So just some examples here, and this is not all inclusive by any means, but property tax, sales tax, income tax, license fees, revenue from the sale of property, including one-time transactions, municipal sewer system revenues. This varies from utility revenue, which is broadly not included. Rent from municipally owned facilities, as well as intergovernmental transfers from the state in particular. So Treasury recognizes that state and local governments often share or collect revenue on behalf of one another. And as I mentioned, this intergovernmental revenue is specific to transfers of state revenue. It would exclude transfers that the state makes on behalf of the federal government in the form of federal revenue. So for example, the fiscal recovery funds. Go ahead and next slide, Dana. A few exclusions from general revenue that we really wanted to call out. Many of you may have refunds or other correcting transactions. As I mentioned, the definition is really meant to include revenue streams that are a function of economic activity. So those accounting transactions that typically go in and out one or more of your funds, those are excluded. Proceeds from issuance of debt or sale of investments. While many of you consider that revenue from an accounting perspective, Treasury does exclude that when it comes to proceeds from issuing debt. Agency of private trust transactions. As I mentioned before, revenue generated by municipally owned electric, gas, public transit, and water supply utilities and insurance trusts. In that document I mentioned that the Census Bureau puts out, they have a lot of really good information around utility revenue. And it's, we would recommend taking a look at that if you're unclear around certain revenue streams that may be associated with your utility, because they may or may not be included or excluded. And just the fact that they're associated with the utility itself doesn't necessarily mean it falls inside or outside of the scope of that definition. And then, as I mentioned before, but I just want to reiterate here, intergovernmental transfer from the federal government. To the extent you receive revenue through the state that is federal revenue, it would be important to attempt to parse out what is a federal portion and what is a state portion to really make sure you're excluding federal revenue that gets transferred from the state. Next slide, Dana. Now I want to briefly walk through the calculation itself. When it comes to calculating revenue loss, the idea is you're going to compare your actual revenue, and there are 4 points in time that you're going to calculate that, to a counterfactual trend. That counterfactual trend is a projection of what you expected to occur but for the pandemic, right? And each calculation period, you're going to compare the counterfactual trend to your actual revenue, and the difference between that will be the amount that's available for the provision of government services. As I mentioned, any revenue shortfall compared to that counterfactual trend, Treasury considers that revenue loss to be caused by the pandemic. So we've received some questions, to the extent that you changed revenue structure or reduced fees or increased fees in some period. The way that would show up would be on your actuals, and you would still compare that though to the counterfactual trend and then take the revenue loss piece there. So any revenue shortfall that shows up, Treasury assumes to be associated with the pandemic, as opposed to looking at individual revenue streams and saying, did the pandemic impact this revenue stream or this revenue stream? As I mentioned, you're looking at it as a whole, and Treasury will presume that a change in that a revenue loss is assumed by the pandemic, and that's an important point to keep in mind. So real briefly, just to go through the calculation, as I mentioned, you're going to estimate the counterfactual trend using a growth rate. So you're going to take a look at your full fiscal year prior to the start of the pandemic. You're going to look at your base revenue number. And you're going to calculate that, as I mentioned, using the general definition of revenue. And then you're going to calculate a growth rate. That growth rate is going to be one of two options. Treasury provides 4.1%, or the municipality's average annual revenue growth over the 3 full fiscal years prior to the COVID-19 public health emergency. You're going to take the higher one of those. Treasury recognizes that certain units of government may have growth rates that extend beyond the 4.1%, and Treasury does allow flexibility in determining what growth rate to use. To the extent your growth rate is less than that 4.1%, you're able to use the higher of those two options. As the next step, as I mentioned, you're going to identify actual revenue. You do this really at 4 points in time. The first period has lapsed, December 31, 2020. So you're able to do that calculation right now. You can look at your actual revenues as of that date, compare it to the counterfactual trend, and that would be the amount of revenue loss that's available for the provision of government services. And then the other 3 periods, the next one is coming up, December 31, 2021, December 30, 2022, and December 31, 2023. The reason for this is Treasury recognizes that for many local units of government, the impact of COVID-19 on a government's revenue structure and economy varies, right? So depending upon the nature of your economy and where you're located, revenues may be recovering at a faster rate than they are for some other regions. And Treasury allows for that calculation to occur at those 4 points in time. That doesn't necessarily mean that you're going to have revenue loss, in each of those 4 periods of time. So the idea is when you have actuals for that period, you compare it to the counterfactual trend, and then you'll have the revenue loss amount. You do that as you go. So, you all can calculate the amount as of December 31, 2020 right now, and use those dollars for the provision of government services. But it's important to recognize that for the later dates, you don't have actuals yet. So we would suggest you all coming up with an internal projection of what you expect actuals to be, to get a sense of if you're going to potentially experience revenue loss in those out years. And the reason why we recommend this is because that will help inform from a decision-making process whether or not you all may want to wait for that revenue loss to occur and then count it, or focus on another eligible category. So I think that's a really important point there, and would suggest coming up with internal projections for your actuals to get a sense of whether or not you may expect revenue loss to occur or not. But again, I really want to harp on, you're performing the calculation as of those 4 dates, and until you have actuals, all you have is the other side of the equation, that being the counterfactual trend. And so you won't, from Treasury's perspective, be able to officially calculate the loss until you have both sides of the equation. Then, as I mentioned, you're going to compare the two, determine the loss, and if so, how much. Next slide, Dana. So we wanted to briefly walk through the state of Maryland's revenue loss calculation, so you can kind of get a sense of what this is going to look like. Obviously, the state's revenue streams are different from your all's, but the calculation, follows Treasury's guidance as it should. So as you can see here, the state of Maryland started by determining the growth rate for that counterfactual trend I was looking at. They established their base year and then looked at the 3 preceding years prior to the public health emergency. And they found, the growth rate associated year over year with those, and then calculated the average. In the state's case, the calculation was less than Treasury's 4.1%. So as you can see at the bottom of the slide, they recognize that Treasury specifies you can use the average growth rate, which in this case was 3.42%, or 4.1%, whichever is higher. Therefore, they're using the 4.1% as their growth rate. Next slide. Here you can see where they, take a look at each counterfactual points from a calculation perspective. You see the point in time, the second column from the left of the slide, that December 31, 2020. And then they have the other 3 points in times, and you'll recognize they don't yet have actuals for that because those periods of times haven't occurred. So they identify actuals as of December 31, 2020. Then they compare that to the counterfactual trend using that 4.1% growth rate to come up with that amount. And then they take the delta between those. For the state, that was approximately 1.6 billion in revenue loss. And they're using that funding for the provision of government services to the extent other categories of eligible use aren't eligible for their specific purchases. Then, as you can see, the other 3 periods are blank. So as those periods come, the state will continue to calculate its revenue loss, and then it may or may not, depending upon the outcome of that, have a revenue loss that it's able to apply to the provision of government services. Next slide, Dana. So now that you understand the definition of general revenue, you've done the calculation, you've come up with revenue loss to the extent it exists, what would be some eligible uses under the revenue loss provision? As I mentioned at the start, Treasury provides broad latitude for local units of government when using the revenue loss provision. It provides flexibility, and that's by program design. So U.S. Treasury in their guidance has provided a non-exhaustive list of examples, and I really want to hit on Treasury's phrasing of non-exhaustive list. These are only examples coming out of Treasury's guidance. The idea, though, is provision of government services. So to the extent you all are performing day-to-day operations that are part of your normal course of government operations, those would be areas that are eligible uses according to current U.S. Treasury guidance. But let's go through some examples here. Maintenance or PAYGO funded building of infrastructure, including roads. We recognize many of you all have asked, how do we get to infrastructure kind of beyond water, sewer, and broadband? This would be a way to do it to the extent you're not able to use, other categories of use. Cybersecurity, other technology, to the extent it doesn't fall in one of the other categories. Health services, environmental remediation, school and educational services, and provision of police, fire, and other public safety. We recognize that a lot of questions have been submitted around, fire, volunteer fire departments, funding those types of services. To the extent you're not able to get to those expenditures in one of the other categories of use, using the revenue loss provision, to the extent you do have revenue for the provision of government services, would be a way to get there. Next slide, Dana. So let me briefly kind of go over some ineligible uses, and then we'll have some time for questions and answers at the end here. While there is flexibility, there are ineligible uses even when using the revenue loss provision. Interest or principal on outstanding debt and expenses associated with those obligations, satisfaction of obligations that arise pursuant to a settlement agreement or judgment. To the extent that judgment or settlement is not part of provision of government services, that's what they're really referring to. There is an exception if the judgment or settlement required the provision of government services associated with that. So just kind of want to note that gray area there. Replenishing financial reserves, rainy day funds, other reserve funds. Treasury has indicated that that is not an eligible use. And then there are overarching restrictions for program funds as a whole, regardless of what category you're using, regardless of the revenue loss piece. Pension deposits, extraordinary one-time pension deposits. Obviously, those that occur through the normal course of operations are treated differently under Treasury guidance. Restrictions on using funds for a non-federal match, where barred by regulation or statute. You really have to look at the federal program and whether or not they bar the use of using fiscal recovery funds from a match perspective. Next slide, Dana. We now wanted to, reserve some time for questions you all have. I know folks have been submitting questions in the Q&A box. We hope that through the course of this presentation, we've answered those questions that you all submitted ahead of time. We really appreciate that. To the extent we haven't hit on those, we will do so as a part of this Q&A section. I did want to thank you all for spending some time with us today, going through revenue loss, how to calculate it, and what those provision of government services could look like to the extent you have revenue loss. We'll now open it up for any questions that folks may have.
My name is Benjamin Shea. I'm from Haggerty Consulting. I have been interacting with a lot of you over the process of distributing funds to NEUs or over the course of the technical assistance process. And I am going to hop on and answer some of the questions that we've gotten. So thank you to everyone who submitted questions either during the course of this webinar or over the or in advance as part of your sign up. Some really great questions, and we're looking forward to continuing to answer them if you have additional questions afterwards. So first question I wanted to address, which is a great question, cash or accrual accounting. Recipients may provide the data for the revenue loss calculation on cash, accrual, or modified accrual basis. The recipients have to be consistent in the choice of methodology they use throughout the covered period. So from the point at which you've begun to calculate your growth rate through to the end of the last revenue loss calculation date, you need to use whatever system you've begun that period with. But either cash or accrual is acceptable. A couple of specifics that I wanted to highlight that we got questions on. We got a question during the webinar: do the calculations assume the same growth rate for 21, 22, and 23? Yes, the counterfactual is backwards looking. So you're trying to figure out what your growth rate was before the pandemic. So that growth rate is going to be the same through the whole revenue loss period going forward. And let's see. We got a question as well about permitting fees over the course of this webinar. Generally, permitting fees would be considered general revenue. There's another, we got a question prior to the webinar that I just wanted to clarify, that asked, that basically asks for clarification on revenue loss for small businesses. The presentation we've covered today is specific to revenue loss experienced by the local government, by the NEU. There is a separate clause, and this is totally different, where support is an eligible use for small businesses that are undergoing financial challenges and need help with operating costs. That is a separate eligible use. It is eligible. We're happy to take additional questions on it elsewhere, but I wanted to make sure that distinction was clear. Let's see. We also got a question prior to the webinar. Has the formula changed since May 2021? No, the formula has not changed since May 2021. We don't necessarily expect any changes. There is going to be a final rule coming out on this. This has been consistent since the initial release of guidance, and hopefully anticipated continue to be so. Are there some questions you're seeing, John, that you'd also like to take?
You can go ahead and proceed, Ben. Thank you.
Okay, great. Okay. There's some questions about actual year versus financial year. The revenue loss calculation is an actual year. So we understand, a lot NEUs have financial year ended end of June. Fortunately, this calculation does need to be done as of the December 31st date. We got a question: are economic business grants taxable to business? That's a great question. It's a little bit outside the scope and might involve something of an involved answer. We encourage you to submit that through our portal, and then we will be happy to get back to you on that. NEUs need to exhaust reserve funds before accessing monies for revenue loss? No. This is money that's available to you. It's trying to make up revenue that would exist in the course of normal if the pandemic hadn't happened. And so you don't need to exhaust reserve funds. You can use the funds for eligible uses as soon as you've calculated the revenue loss. And yes, you can. Sorry.
I would just add there, Ben, that one item for you all to keep in mind is around flexibility of use of funds. There are restrictions, as you all are well aware, on these use of funds. From your reserve perspective, to extent there are local designations that restrict funds, that may be the case. But in general, those are going to be more flexible than the fiscal recovery funds. So when you're thinking about what types of expenditures to fund out of what funding source, you really want to look at it on a sliding scale from those programs that are most restrictive to least restrictive. And to the extent you can match expenditure types to those programs and those funds that are more restrictive, you really want to focus there and reserve funding that is least restrictive for other uses. So a bit outside of this particular webinar, but I did just really want to take the opportunity to make that point, given the amount of federal funds and state funds and other funds that are being made available at this time to support folks' recovery from COVID-19 and the resulting negative economic impact.
Thanks, John. And building off what John said, there's a question about restrictions on uses for fire and police, etc. That's one of the great things about the revenue loss. Generally, there aren't very many restrictions on what they would be able to use these funds for. They're for the provision of government services. Again, there may be some, outside of some of the explicitly ineligible activities that are allowed, like contributions to a pension fund, that there's really a lot of flexibility on how they can be used under this specific revenue loss clause, up to the amount of revenue loss. We got a question: do you advise spending money on single-year projects rather than supporting continuing operations with these ARP funds? This is something that we, I think, touched on in our previous webinar a little bit. But I think that's really a question for the NEU. This is certainly a situation where this is a one-time funding amount that is coming from the federal government. So certainly if there's funding of continuous operations, that's something to be mindful of. But that's really beyond that consideration, and with proper planning, I think either of those is really
yeah. I just want to add here that as Ben mentioned, this funding source is by definition one-time in nature. So while it's the responsibility of each of you to kind of determine from an eligibility perspective, from a best practice standpoint and kind of industry standard, you really want to look to match one-time expenditures with one-time revenue. To the extent you are funding operational items using this funding source, we would recommend that while that may be an eligible use, we would recommend from a best practice perspective that, as Ben mentioned, you have a plan, because this funding source will end one time in nature. The other thing to keep in mind is, to the extent you create additional ongoing expenditures as a result of one-time investment, for example, a capital expenditure that results in ongoing expenditures of some sort, whether it be utilities or additional staff or rent, maintenance, etc., we suggest and recommend taking that into account from a planning perspective. To the extent you're able to fund those in the interim with fiscal recovery funds, that may be a potential route for you all, but you may create additional ongoing expenditures that, once the grant ends, you'll need to fund from another source. So again, while Treasury does not necessarily disallow use of this funding for ongoing expenditures, from a best practice perspective, we would suggest, trying to match one-time expenditures with one-time revenue.
Thanks, John. We got a question on whether the revenue loss calculation is cumulative. This is a point in time calculation. So at each year, you should measure whether the growth rate is greater than, or the growth rate is greater than the counterfactual, has grown more than the counterfactual, or whatever the growth rate was from before the pandemic, and see if there is revenue loss for that year. Our best understanding at this time is that this is done on an individual year basis. It's not, if you've exceeded that growth rate, then there's no indication that there's a cumulative and there needs to be some offset. But that is, that I don't think that's 100% explicit. But I think in general, you should think about this every year, do the calculation. If you don't have revenue loss for that year, then this is just not an option for you at that point. But going forward, yes, there is a, once you've shown that there's a revenue loss for this year of $100,000, there's still that $100,000 you can use it, obviously, into next year. If you've got another $100,000 the year after, you haven't spent any revenue loss yet. You've shown $200,000 total of revenue loss. That is available for your use until the end of the period. When do revenue loss expenditures need to be spent by? They would conform with the regular cover period of the fiscal recovery funds. So funds need to be obligated by the end of December 31st, 2024, and then spent by the end of 2026. So this would be the same as the rest of the fiscal recovery funds. I'm happy to stick around for another minute and take a few more questions, but I believe we've covered all of those questions that have come in. We also encourage you, we're happy to respond to any and all questions through the technical assistance portal. So please continue to send those in. And yes, there have been times when we've gotten questions coming in, and we have begun posting those as an FAQ on this website for NEUs. So the questions that are coming in that we think are really important for everybody to know, are continuing to update that FAQ document. So please keep your eyes posted on that.
I just want to note, we got one question coming in towards the end, Ben, Philip, following up on the commentary around linking one-time revenue to one-time expenditures. The question was around, would it be advisable to use the one-time federal funds to pay for ongoing services so that regular revenues can be used to build financial reserves until the revenue picture is clarified? So again, this is really, operating with uncertainty. We would suggest that as part of your financial planning, you really, I think as implied in the question, take a look at longer term projections to understand when you can expect general fund revenue streams to either return to pre-pandemic levels, or really to understand what those revenue streams are going to look like moving forward. There may be structural changes as a result of the economic impact where those revenue streams have changed at a fundamental level because the nature of the economy or the way individual revenue streams work have changed at a fundamental level. So we'd suggest for each entity, you take a look at those longer term projections and then make a decision informed by what you can reasonably expect to occur. Obviously with projections, having worked in local government before, the one thing I know about projections is they won't pan out. So you'll be close, but reality will set in one way or the other. So we'd really recommend taking a look at those longer term trends and then using funding in a way that supports an overall strategy from a financial and economic recovery perspective. I don't think we've had any other questions come in. With that, I wanted to thank you all for your time here. As Ben said, please continue to ask questions. I'm going to turn it over to Emiliano from our team, who's going to provide a few updates on the technical assistance program as a whole, and what folks can expect in the near term as well. But thank you all very much for your time, and we appreciate the continued partnership with the state, with the Maryland Municipal League, and with all of you. Thank you.
Thank you, John, and thank you, Ben, Jeff, and Tom. Once again, thank you everybody for signing on today. We will be sending out these materials in a follow-up email, so you can expect the presentation. We'll also be posting this on our website, including the recording of this session. And as we said in the beginning, please keep your eyes open for our news. We will be sending a newsletter in a couple of weeks, and we plan to do an additional webinar sometime in December. So we'll follow up with a specific date in these next few days. And thank you again for your time. We look forward to continuing to answer questions and supporting, and happy to be here. Thank you very much.
Thank you, everyone. Have a good day.